All right, everyone. Welcome to our session 3 of Tom's Trade Essentials. And I know some of you are here for the very first night. We'll talk about how you get sessions 1 and 2. But this is something we've started this year in 2016. Glad to have all of you back who were here for sessions 1 and 2. This is session 3, how we trade earnings patterns with 100% historical accuracy. So what we do is we're doing a series of sessions. And our last session in the series is kind of a wild card session. So we decided the best session we could do right now was trading earnings, because earnings season is now upon us. And who better to have with me tonight to teach earnings than Mike Wade, he is really our earnings scalper, if you will. Mike, how you doing tonight?
I am doing fantastic, Tom. How are you?
It is great. It is awesome to have you here. I told folks and I emailed them and I told them that really this is the one time a year that you have to go over this, because we're not going to have you on again for another year because we just have so many other things going on. And you're busy. I know you're busy, and I want to thank you for taking your time out tonight. There is one other chance that a few folks in the room can see you, and we'll talk about that at the end of the program tonight. But right now, let me spend a little bit of time with everyone, and I want to do a rewind. I want to talk about week 1 and week 2 very quickly, and then I want to go into a beginning part of tonight. Then I'm going to turn it over to you. So that's my plan for tonight, guys. This session is being recorded. You can ask questions in the Q&A box down there. I'm going to tell you right now, we got so many people in this room. I'm going to apologize on behalf of me, Mike, Jay, because we will probably not be able to get to all of your questions. But if we don't get to your question, you are welcome to ask it to us through email if we don't get to you tonight. And that email address, and I'm going to put it in the chat box if it's not already in there, and that is support at tomgentile.com. All right, support at tomgentile.com, and that's going to come to all of you right now. You should see that on the box. So I'm going to send you a couple things through here throughout the night, and so I want to make sure you guys know that in the chat box is where we'll be talking to you through text. We'll answer as many questions as we can. Session's being recorded. Last thing I want to talk about is this disclaimer. All right, and we put this disclaimer up in every webinar that we do. Just very quickly, a couple things I want to note on here. You can read this from cover to cover. Some important things. Obviously, stock and option trading has large potential rewards, but also large potential risks. You must be aware of these risks and willing to accept them in order to invest in the stock and options market. Remember this, guys. We're what we call RBT traders, rules-based traders. Rules-based traders, what they do is they find a pattern. They then backtest the pattern and feel comfortable with that pattern's validity before we go in and put in real money to it. Keep in mind, when you backtest, you're using what's called simulated trading. All right, and backtesting may over or undercompensate things like lack of liquidity. So that being said, also, I want to let you know that me, Mike, Jay, and everyone associated with Tom's Trading Room, LLC, all right, we're your educators. We are not your brokers. You need a broker to trade with. You must meet certain requirements. And everything we're going to talk about tonight is in U.S. dollars unless noted otherwise. And that's all I got to say about the disclaimer. So our focus tonight, all right, our focus tonight is going to be how we find earnings patterns with 100% historical accuracy. Number 2, how do we identify potential 50% or more payout appointments during earnings season? All right. How we find low-cost opportunities regardless of direction. The most that we're going to look at on a particular trade we're going to show you tonight is $2,000, but let me tell you what, most of them are going to be often far less. All right, and why we insist on taking profits within 10 days or less. This is our focus for tonight. All right. Now, before I get into our focus, I am going to talk a little bit about what we've done in our 3-week series. So week 1, if you joined us on week 1, we talked all about calls, what call options were, what put options were. We didn't spend a lot of time on that because I'm to the understanding that I believe most of you in the room know what calls and puts are. But we showed you how we trade them, why we favor certain strikes in the money, at the money, out of the money. Okay, and then we showed you how we trade them using a little product that we've created called the Money Calendar. All right. In week 2, we talked about we did a review. We also talked all about spreads. And we talked about debit spreads, all right, bull call, bear put spreads. And we used something called our darknet contrarian strategy to help us spot opportunities with these typical spreads, or what we call loophole trades. All right. Now, for those of you that missed these sessions, or for those of you that want to see them again, all right, all you've got to do is this YouTube channel. You can find all of our videos. We've got over 100 of them there. www.youtube.com/Tom's Trading Room. Okay. I'm going to put that in the chat box for you, and I'm going to add all that hypertext stuff too. So http://www.youtube.com/Tom's Trading Room. All right, if you click on that, that takes you to our YouTube channel, and then you can find all of our shows there, all of our webinars, and a lot of our little 5-minute video how-to videos as well. So that's where you get all that information. So let's continue. So a quick little review. All right, and I'm using Apple because all eyes are on Apple. All right, I just did a radio show, and we were talking about Apple. We're talking about Apple announcing its earnings on Tuesday, and how they're expected growth to go higher. They're expected their revenues to go higher, earnings to go higher. Then we talked about particular products, and what I discussed with everyone was things that you can find anywhere. All right, you go to earningswhispers.com. You know, you can find the whisper numbers on anything. All right, this is stuff that everyone has access to. Then I started talking about things that only we have access to, and that is the kind of data that allows you to go in and look and see, did Apple really, what does Apple do before earnings? What does Apple do after earnings? All right, what does Apple's implied volatility on its options do before earnings? What does the implied volatility do after earnings? And let me tell you this, I actually did a quick little 5-minute video. I have not even uploaded it yet. All right, I did it right before the show. In fact, Mike was calling me to find me. That's how close to the show I was doing this. And it was a quick little video. I was talking about the stock market. I was talking about our 4-day week this week. And I was talking about Apple's earnings. And I was talking about the fact that what I showed, and I have it in the video, and you'll get it. You'll get a copy of it. All of you will. And it shows what we use looking at something called earnings effects to determine whether Apple has a pattern before earnings, after earnings, whether the options have a pattern before earnings or after earnings. And we really found 3 patterns, okay, with Apple. And we're going to discuss some of these patterns with you tonight. But what I found with Apple is, if you're waiting until earnings, you waited too late, okay? You waited too late because it's now the weekend. Monday's going to come along, and Apple announces on Tuesday. Let me tell you what, getting an option on Apple right now is probably very close to getting Super Bowl tickets, all right, to the big event coming up in a couple of weeks. It might be, that's the kind of money you're going to be paying, you know, to get into an Apple position, and you might be paying too much because this was one of those buy the rumor and sell it before the news type of events. And we're going to talk about this a little bit more. In fact, I'm going to let Mike talk about this a little bit more. But if you're looking at the graph that we have right here, we're talking about just a call option, all right? Now, remember, where's our risk in a call? It's in the premium purchased. Where's our reward? Well, it's people like to call it unlimited. I call it a lot of upside reward until you exit, okay? So limited downside risk. Again, I'm not going to get into the mechanics of a call. We did that in week 1. We also talked about the mechanics of a put. But looking at Apple, this is an example of the Apple put option. This is with 1 week to expiration, all right? And you're seeing this particular option. Let me just tell you this right now, guys. The time premium in these options are double what they were just a few weeks ago because everybody's excited now. Excited, nervous, all kinds of emotions are being put into the premiums of these options because of what's going to happen on Tuesday afternoon because nobody knows. All right, nobody knows what's going to happen. Nobody knows what Tim Cook is going to say. Sometimes now, the earnings are not as even as important as the conference call these days. It's not maybe so much what the number is going to be, but what these guys plan on saying afterwards that really drives these premiums up, only for them to crash down the day after earnings. All right, so again, when I look at a put risk graph, where's the risk? It's directional if Apple goes up. Where's the risk? it's nowhere if Apple goes sideways. It's right there if we go sideways. The only way you make money on this one is if Apple were to crash down, all right, past its lows of a couple of days ago, all right. And so that's the risks that you see when you're putting on long calls and long puts. You have delta risk, that's your directional risk. You have theta risk, that's your time decay, your time risk. And you also have, as we get into earnings, you have volatility risk, because volatility can be quite high at that time as well. So how do we get rid of delta? Let's get rid of a couple of risks. So I'm going to show you how to get rid of delta risk right now. And that's with something called a long straddle. And that's where you're actually buying simultaneously an at-the-money call and an at-the-money put, all right, with the same strike price, the same expiration date. You now have really kind of thrown off your delta risk because you now have delta neutral trade, all right? But what has happened? You've now gotten rid of delta risk, but now you have theta risk times 2. Now you have vega risk or volatility risk times 2. So when you get rid of something, something else comes along. All right. Now the great thing is that we're all about inefficiencies. All right, and we look for inefficiencies in the market because if the markets truly were random, nobody would make money except brokers, traders, and folks on the other end of the equation, all right? But because I kind of believe the markets have supply and demand and fear and greed, all right, that there are inefficiencies that we can find. Patterns they come out of inefficiencies, okay? So at this point, I was going to do a question and answer session on what's a call, what's a put, what's a straddle, but really, I think what we're all kind of looking for is where do we find? I got a question for you. In fact, you know what? This is the part where I ask the question, and the question I ask is this: what are the biggest risks to long option traders? And I already gave you the answers. There's delta risk. That's the direction, especially if you're long calls or long puts. Theta risk if you're long calls or long puts or long calls and puts, and vega or volatility risk. All right, these are your 3 biggest risks. To get rid of the first one means we put on a delta neutral trade. How do you get rid of the others? Well, we could spread our options back and forth, and we know that's a way of cutting them down. But what we want to do is show you something that a lot of you in the room have never thought about before, and that's what we call a temporary solution. Okay? So, is there a way to temporarily negate all of the risks within a single event? All of the option risks? Yes, we believe there is. All right? Most of the time there is. Not all the time. Most of the time there is. And one event can sedate option risk for a short period of time. So what we want to do is we want to teach you how to trade straddles like a master. And this is something that I can tell you it's taken over 10 years to perfect what we're about to show you. Okay? Mike Wade, are you ready to
I am ready, Tom.
take over? So what I want to do is I want to turn this over to Mike. And so at this point, let me find Mike in the attendees. We got a lot of people in the room tonight, Mike. So, I found you. I found you.
All right.
Here you go. So I'm going to make Mike the presenter. And while you're bringing this up, I want to share something with the group. So I was asked a question yesterday by a good friend of mine who he heard this on a radio show or something, and he said, if you could trade your intelligence for one thing, this was someone polled 100 people, and he heard this and he asked me, he goes, Tom, if you could trade your intelligence right now, if you would trade your intelligence for one thing, what would it be? Money, fame, this, that, and the other. And that was an easy answer for me. I wouldn't. I would not trade my intelligence for anything in the world. There's no dollar amount on this planet that's worth my intelligence. And that being said, what Mike and I are going to do is we are going to share some of our intelligence with you right now with something that we call breakout mastery. And Mike, I'm going to turn it over to you. It's all yours.
Oh, great, Tom. Thank you. Well, first off, I've got to say it's a pleasure to be with so many Optionetics students. I started teaching for Optionetics in 2002, and I taught for right around 12, 13 years. I went to Australia, taught all over the world. I'd say I probably taught tens of thousands of people, and over that time, I developed a very deep love for students and wanting to be someone who made an impact on the lives of people. And I have to say that those 10, 12 years, well, 12, 13 years were arguably some of the best years of my life. Great people like Tom and Christina and Nick Gazzolo and George Fontanals and Jay Harris, who's on the call with us tonight, and then you as students. It's just a real pleasure to be back with you virtually right now, and I'm looking forward to hopefully spending some more time with you over the next 12 months. Anyways, so yeah, I've been trading since 1998. I quit my job May 28th, 1998. I remember exactly the day. It was a Friday, and I walked out and I started trading, and I got into selling options, right? So naked puts, in fact. I learned how to do that from a cab driver, and you might know who he is. And I did well, and then I didn't do so well in 2000. And then I came to Optionetics. I learned how to actually trade correctly, and I've been trading properly since 2001, and 2002 is when I started teaching with Tom. So anyway, a great pleasure to be here with you. I've been a credit spread trader my whole life. I still am. And over the last 5 years, having taught many levels of classes to the advanced classes, I really got myself focused on finding a system that was simple and worked. Finding a system that even the beginning trader would have no trouble trading and can make some money. So I was on the lookout for years for that, and there's a lot of different ways to do that. But tonight I want to cover what I consider to be, in my humble opinion. Actually, I don't have a humble opinion. My opinion is coming up. But first off, I want to make a point here. So if you've been in the market over the last month or so, you've been on a wild, right? So directional trading in the kind of market we've had from December through now can be a bit of a nightmare. If you buy calls in this market, it's risky. If you buy puts in this market, it's risky. The market goes down big, it goes up big the next day, hundreds of points in either direction. So when you're in this kind of a market, it's very treacherous to trade directionally. And directional trading is like buying long calls and puts that Tom just described. Semi-directional trading like credit spreads, you get on the wrong side of a correction or a whipsaw in the market with a credit spread, and it gets really nasty fast. So this particular strategy that we're covering tonight is actually well placed in this market, right? So this strategy tonight that I've come to love for a lot of reasons, as you'll see in a few minutes, is the perfect strategy to trade in a market where you just don't know where the market's going to go. So here's an example. You can see this is the SPX actually, and you can see how whipsaw the market's been since since really August. So and then the volatility you can see as well. The implied volatility is also all over the map. All right. So volatile times call for a strategy where you're being really smart about mitigating, in fact, eliminating directional risk. In fact, direction is your friend. It can only be your friend. So let's get into the meat. Now, trading is really simple, right? It comes down to identifying patterns, historical patterns that tend to repeat. And then based on these patterns, applying a particular strategy that makes money if, in fact, these patterns repeat. So we're looking for patterns. We're finding systems that work based on the pattern, and then we apply into the future these particular strategies. So given that we're looking into the future, that's not really guaranteed very often, but there is one guarantee, and Tom mentioned it. There is one event that we know is going to happen on a particular date. These dates are announced by companies, and these are earnings announcements. So every 3 months, publicly traded company is required to place an earnings announcement, and we know what those earnings announcements are. All right? So there's a pattern that repeats, and we know it's going to repeat, and we know exactly the day it's going to repeat. So this is really the foundation of the probability behind this system. All right, now what happens on earnings announcements sometimes for some stocks, and actually a lot of stocks? Well, here's an example of a stock called Amazon. You may have heard of it. Amazon, as you can see in this stock chart, and this is a bit dated. This is from the Q3 of last year, but on the chart, you'll notice that there are these green arrows with E's in them. That's an earnings announcement. So here you have Amazon. It's moving along, and then earnings happens, and the very next day, Amazon gaps down. Amazon goes sideways for 3 months, and then earnings happens, and the very next day, Amazon gaps up. Same thing happens again. Earnings happens here, Amazon gaps up. Earnings happens three months later, and the next day, Amazon gaps up. So that's a pattern. So given that we know the E's coming, we know when the earnings are coming, we can use this fairly inevitable pattern to make money, to find a strategy that makes money. Now, the strategy that we're looking at tonight is the straddle. A straddle is buying a call in case the stock goes up and buying a put in case the stock goes down. And we don't know for sure which way the stock's going to gap after earnings. What we are counting on, and if history repeats itself, and it's done 4 times on this chart, then we can count on Amazon gapping one way or the other. And if it gaps up, our calls make more money than our puts lose, and vice versa. So does this happen with just Amazon? No. It happens with many stocks. Green Mountain Coffee is another example of a stock that gaps at earnings. Another one, SanDisk, another example of a stock that gaps at earnings. So traditional straddle traders will buy a call and a put before the earnings announcement and count on the stock gapping. So that's the basic strategy for straddle traders. There's other ways to trade straddles, but that's pretty much the majority of people that trade straddles use the earnings announcement as a trigger. All right, now, it gets better. So with the power of earnings announcements and stock gaps comes the power of implied volatility. And Tom mentioned that already. Implied volatility really breaks down to demand. So when the demand for the options increases, market makers, those that are making the market and selling you their options, will raise the price of the options to meet the demand. So a supply and demand kind of curve. All right, so what happens is that the expense of the options increases even if the stock doesn't do anything, totally based on demand. Now here's the beauty. What that does is produce something called an implied volatility chart that looks just like this, remarkably like this one. This is one on Green Mountain Coffee. And what you can see here is a very beautiful, this is my favorite pattern in trading. I've got to say, I've come to love this pattern because it happens a lot. So what you see here is, let's just call it a demand curve, right? So here you have earnings coming up. And then into earnings, what happens is option traders, we know when the earnings announcement is. So we come in and we buy our calls and puts and buy our calls and puts. Demand increases. Option market makers lift the price of the option, and the options get more expensive. And this expense has nothing necessarily to do with the movement in the stock. It happens because of anticipation. I would say the emotion behind this rise in the implied volatility, Tom, would be greed. Option traders are looking for these big gaps, so they'll pay a premium for their options in order to capture the gap. So that's why it's there. And does it happen on other stocks? Well, yeah. Here's one on Amazon. Look at these beautiful heartbeat patterns, just like a heartbeat, right into earnings. Right into earnings. So implied volatility rushes in and makes the options that you buy more expensive into the earnings announcement. So the question obviously is this a pattern that we can trade? Well, absolutely. We can buy something, how about a call and a put, before the earnings announcement, and that straddle, that resulting straddle, will get more expensive into the earnings announcement. So that's a strategy that Tom mentioned we've spent years developing, And as I go into the balance of the night, you're going to see a really innovative and sexy, quite frankly, way of trading volatility, trading expense of the options, trading the demand of the options. So I'll get more into that later. We call that the, I'm going to call it right now the red wave strategy, and I'll cover that in a minute. But before we do that, I want to talk to you about, Tom introduced straddles, but I want to talk to you a bit about basic straddles. I want to talk about what's good about them, what's great about them, in fact. This is traditional straddles. What's not so great about them, what's bad about them, and maybe even what's ugly about straddles. So I'm going to do that with some examples. And I'm going to start with this this stock here. I'm in Tom's Trading Tools right now. Let me zoom in a little bit so you can see a bit better. What I have here, the date, if you want to backtest this, if you happen to have the tools and you want to backtest, this is based on, this trade was placed on 3/16/2015, and Netflix is one of those companies that gaps at earnings. All right, so what we did here on the 16th is we bought 4 straddles. So we bought 4 calls, and we bought 4 puts, same number. So we bought 4 420 calls, and we bought 4 420 puts, and we spent, what's that, $61 or so per contract. $62 pretty much. Now, the risk graph looks just like what Tom was showing before. So there's your beautiful, that's actually the ideal. I'm going to zoom in out a little bit so we can see the whole thing. This is an ideal straddle. It's beautiful. It's perfectly balanced. The stock price is right at the apex, or the point of the witch's hat. The profit in the straddle lives above, to the right of this break-even line. So you can see here that if the stock moves up, let's say it goes up to 480, we'll make a measly $8,700, and if it drops, well, to 360, we'll make about $6,380 some dollars. So if the stock moves any which way, that's good for us in this particular trade. So is there directional risk in this trade? Absolutely not. There is no directional risk in this trade. Direction can only help you. The stock price movement can only help you in this type of trade. So one of the things we refer to, one way to describe a straddle, I should say, is a delta neutral trade. Delta neutral means there is no risk in direction. And a beautiful thing for this market in particular, but all markets for that matter. All right, now, so is there risk in a straddle? Yeah, absolutely. And the main risk in a straddle, there's 2 main risks in a straddle. The one that will be something to contend with in every straddle is time decay. So before I go into time decay, let me just briefly review the rules of the traditional straddle. This is how most people do straddles. What they'll do is they'll place the straddle 30 days, I'm pointing to the stock chart over here, they'll place the straddle 30 days before the earnings announcement, and they'll use 60-day options. So that way, in 30 days, my 60-day options will now have 30 days of time in them. And that will allow me to avoid the impact of rapid time decay that occurs in the last 30 days. So all you optionetics students know that. We tell you in optionetics, never buy, never hold long 30-day options. And the reason is exponential time decay. Theta will eat your lunch in the last 30 days. So that's traditional. Now, the time decay risk. What I have in the risk graph, just to give you a quick description, you've seen this risk graph before if you've been to an optionetic seminar, but let's just quickly review. So what I have here is 4 time frames. The red line is today. So on the day we placed the trade, we had 60 days of time left. 20 days later, we will have 40 days of time left. 20 days from that, we'll have 20 days of time left, and then 20 days from that, we'll have expiration and no time left, no time value left. So what you can see here is as we go from 60 days, this is if the stock stays where it is, here's the risk in a straddle, one of them. If the stock stays where it is and we go from 60 days to 40 days, Now we're down $4,300. If we wait another 20 days and go to the green line, then we're down $10,000. And then if we hold this to expiration, which you should never, never do with a traditional straddle, you'll lose the lot, as they would say in Australia. All right, so that's a risk. Now, one of the benefits, though, of implied volatility rush, this increase in demand for the options, is that you can see here in the last earnings period, the demand increased and the options got more expensive into earnings. And then the next day, this is really important, the next day, IV comes rushing out, crush your option positions. IV comes rushing out. And then as we're approaching, we're 30 days out, you can see that the IV is starting to rush in. Now that's going to benefit our straddle. That's
So
actually
Mike,
going to push. Yes.
So a couple of things. First, questions that were coming in. When it comes to strike price, you're typically looking at the money options, correct?
That is correct for a traditional straddle, yes.
All right. And then when it comes to volatility, are you suggesting that we throw out or maybe just set aside the traditional way of buying 60 days and selling 30 days and replacing it with buy as the volatility is low and sell right near the tippy top of volatility before the earning?
Yeah.
Okay.
Who's the advanced person in this class? That's awesome. Yeah, we're going to get there. And so we're going to talk about how we can actually just ride this red wave. So I'm going to get there in just a minute. And great question, great leading question. And I'm going to go into that in great detail because that's where the sophistication lies. That's where the new system that Tom and myself and the developers have put together. And I'll cover that in just a minute. So if you could just sit tight, I want to make sure everybody understands the basics. And then we'll dive into the good stuff, if you will. Awesome. Any other questions, Tom?
No, that's the majority of the ones that are coming up involving what you've talked about right now.
All right, great. All right, so let's go to we're going to go to 4:15. You see where my pointer is down here. 4:15 is the day of earnings, and the earnings happens after the market close on 4:15. So let's go to 4:15. We're using the backtesting tool, and let's take a look at what this straddle did. This is the day before earnings. So market closes at 4 p.m. This is how much. Did I go too far? I think I did.
Yeah, and Mike, I don't know if a lot of our subscribers don't even realize that right there on the chart, it will show you the earnings date and whether it happens before market open, it'll say BMO, or after market close, AMC. And so that's something
Right.
that I wanted to point out to everybody.
Yeah, good point. Yeah, it's all in there, right on the same screen. It's very, very handy. So what I'm doing here, just to emphasize Tom's point, is I've set my date to the actual earnings, the day before earnings, the day of earnings, and this is the closing price. All right. So at the close, the last trading moment before the earnings announcement, 4 p.m. Eastern Time, this straddle was up 20%. All right. So and look here, you can see the stock's actually has risen into the earnings announcement. So now we're looking at 20%. The system, though, says wait till the next day. So if I waited till the next day, so this is the morning after earnings, the next closing price, you'll notice that this straddle, which had 20% profit, ended up with 138% profit the next day. So that's an example of where straddles are awesome. The problem, though, is that this is an exceptional case. Let me take you to the next example and show you what can work against you in a straddle. So here's another trade on Netflix, and in this case, we're placing the straddle roughly 28 days. I've got my pointer down here with the earnings information. About 28 days before the earnings announcement, and we're using right around 60-day options. This is within the rules. And if I take us to and look at the risk graph, similar risk graph, gorgeous, just perfectly centered risk graph. And I want to take us to the day before, or the day of earnings. So at the end of the market day, let's take a look and see how much we had in this trade. So again, this is 4 p.m., the day of earnings, and already we're down 20%. So here we have the straddle has actually lost money. So we're waiting. That's not necessarily a problem if the stock gaps enough the next day. So you can see here that time has worked against us and actually pulled these lines into risk. So we've lost a little bit of money. The implied volatility, you can see here the red line is elevated. And let's go to the next day. Now this is going to illustrate the risk in a straddle, and this is what there is to contend with. And we've got the answer, so don't worry about it. The next day, guess what the stock did? 1 day later, the stock did absolutely nothing. It dropped a little bit, pretty much just beneath where we got in. This straddle then ends up losing 52%. So why did it lose 52% in 1 day, or 32% additional in 1 day? And the reason is the implied volatility came rushing out and left us with a 50% loss in this trade. So the IV, 1 day later, the IV tanked, and it sucked those lines into risk. This, ladies and gentlemen, is one of the reasons I didn't trade straddles for a long time. I'm not willing to contend with this kind of risk. The stock has to move sufficiently to offset these massive IV crushes.
So what you're saying, Mike, is rather than flip a coin, which is always going to be against you more often than with you in terms of looking for that big move outside of the V there, which is the straddle, you would rather take a smaller move, but they're really not that small. Actually, you were telling me your average that you've seen averages around 50% in many of these cases. This is almost like we were calling it a ticket scalping. So let's say, Mike, you and I are at Barclays Arena in Brooklyn, right? And the Beyonce concert is going on, right? We both got tickets. We got tickets, maybe not front row, but we got both tickets. We're trying to get rid of them. If you're out there an hour or two before the Beyonce concert, you're not even going to have to sell them. People are going to come looking for you to buy these tickets. But if
we might even sell more than face.
Yeah, as soon as the curtain rises and the show starts, all of a sudden, where did all those people go? They're gone. You're on the street yourself screaming, tickets, tickets, I got tickets. Nobody's selling them. No one's buying them. You know why? Because the event has already started. And this is exactly the same thing. And so when you look at this, and Jeff brought up a good point. He said, still, when you look at the earnings, you still want to verify them. Use one or two different sources and make sure that you're spot on with those earnings being on a particular day. So you're selling you're scalping those tickets before that event starts. And the other thing is that Jeff's one of our partners who went through your program last year. So he was with you last year, and he just let me know, and I'm passing it on to you. He got into the Apple trade that we were talking about, and he's already up 22%. So he's going to be scalping those tickets before, to some unsuspecting buyer who's going to buy probably right before the earnings announcement and try to go through it. And, we've seen Apple pop, but more often than not, these stocks end up doing less than the expectations of the traders. And we see volatility dropping, and we see the profits dropping. And so it really is best to, like you say, surf the red wave and be off the red wave before it falls over.
Yeah, exactly. And that's the strategy. It's really a smart way to handle it. Let's go back to this IV chart, and I'll describe what Tom's talking about. And riding the red wave, I call it. And the red wave, I'm referring to, of course, the red line on this chart. So this is an IV chart, and it's broken into 4 time frames: 7 to 30-day options, 30 to 60-day. Let me back up. 7 to 30-day is red, 30 to 60 blue, 60 to 90 green, and over 90 days black. So notice where the IV rush is. Jay, here's a question for the audience. Why is the IV so much higher in the 30-day options or less than it is the other ones, all the other ones? Why is that? Why is the demand more for those options that are expiring within 30 days? Why is that? Why do you think that's happening? And while you're answering, notice how the IV rushes on these shorter term options. And as Tom said, after the event, the earnings date in this case, we're not talking about Beyonce in this case, we're talking about the earnings date. The earnings is out. The gap has either happened or it hasn't. And then what happens to demand? Well, it goes right back down to where it came from. This is called IV crush. This is the risk in straddles that there is to contend with. So as somebody said earlier, the smart way to play this is to hop on the red wave and ride it up and get out before the earnings announcement. Scalping is one way to think of it. That's the trick. That's the idea. That's the new thing. Now, go ahead,
Mike,
Jay.
the answers that are coming in are very much very similar. I mean, one is close to expiration, demand, greed, that the options are going to be cheaper for the gamblers, and you know what? That's a very good answer. Is that it's all about procrastination, and I want the big money now, and there's a lot of emotion that is tied up into that particular option. By the way, if what happens is with the other options is they'll drop too. The blue and the blue line will drop, the black line will drop, the green line will drop, just not as much because they weren't pumped up as much going into the earnings.
Yeah, exactly. And Tom, when I saw this pattern as a trader, as a credit spread trader, I'd want to sell the options when they're expensive. But with a pattern like this, though, the problem with selling an option, selling a credit spread, for example, is that there's no high IV for no reason. So the problem with selling a credit spread at these earnings announcement is there can be gaps. I mean, there most likely will be a gap, and that can work against you. So it's risky to do it. Now, which is one of the reasons before I got into really focusing on this pattern and figuring out how to make money with this pattern, it was usually something to contend with, something to watch out for. And over time, I really dug in and started to really get smart about what can we do to make money on this pattern. So the obvious thing is to buy some options here, somewhere on this curve, and sell them up here. Now that's the trick, Tom. Where do you get in? When do you buy options? Well, ideally, right there, right? But one of the issues with buying, and now let me just, we're kind of breaking off the chain here. We're breaking the rules. So settle yourselves if you're getting uncomfortable, because I'm actually going to start suggesting that with this strategy, we buy options that expire in less than 30 days and even expire the day after earnings. We're even talking about buying weekly options and maybe holding them until expiration, the day before expiration. Yes, I just said that. Why would we ever do that? Well, if the IV rush is sufficient enough, there's money there for us. So let me ask. I ask this question every time I do this slide, and let me see how the students are, Tom, here with how they remember the rules. What is the drawback, though? For every day that we're on this curve, we're waiting for IV to rush. What's the problem? What's going to be working against us as we're waiting for the IV to finish its rush? Let's say we get in a week before. What's the problem with waiting 7 days as IV's rushing? What's nipping at our heels, or actually taking chunks out of our rear end? What's happening as we're waiting? What's hurting us? An analogy I like to use is surfing in Australia. Big waves in southern Australia. But what else do they have? Well, they got big white sharks, great white sharks. So you're surfing these big waves, and there's sharks all around. So what's our shark in this case? What's eating our lunch here while we wait? Any answers?
Oh, it's almost unanimous, Mike. It's time or theta decay.
Ding, 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 ding. That's it. Now, so here's the trick. When to get in? When do we get in? Do we get in 1 day before? You get 1 day of rush? Do we get in 2 weeks before? Do we get in 10 days before? When do we get in? And the answer is it's different for every stock. And when I first started doing the strategy, what I would do is get a handful of stocks and then go back and back test. In this case, we have 4 earnings periods, and I would try 20 different entry dates. So 80 different trades, and then looking at the results for each earnings period and figure out the optimal time to get in so that we can balance the offset of IV rush and theta decay. So what we have here is a battle between IV rush measured by vega and time decay measured by theta. So they're button heads. So I stopped doing the strategy because it was too arduous. And so what I did is I called up Tom's developers and I said, guys, can you do something for me? Can you run a scan that has backtesting in it that goes back and tells me which is the optimal day to get in each of these earnings periods? And they've done it. And I'm excited about it beyond description. And I'm going to show you some of the results here in just a few minutes. All right. So what's an earnings scout? Well, as I said, it's been developed over last 10 years. We tend not to talk about it too much because we don't want everybody knowing. Sometimes what happens, Tom, is when a lot of people learn a particular strategy like this, it doesn't work as well. So we keep it kind of close to the vest. Yeah, these scans go out and hunt for opportunities. And very much like a ticket scalper, you're buying options right before they get more expensive before the event, and then you sell them before the event starts, and you make money on the expense of the options. And if the stock happens to move, you make money on stock movement as well. So, each day the software crunches millions of data bits and finds these breakout patterns. We have very specific criteria that meet liquidity, price, historical backtesting. And we look at the S&P 500 primarily. There's a lot of liquidity there, ETFs as well sometimes. And we look for 100% historical accuracy. So imagine this. Imagine being able to find a stock, and you know that if you get in 10 days before the earnings announcement, and the reason you know to get in 10 days before is that the stock over the last 4 earnings period or 10 earnings periods has produced an average of 35% profit. Would you be interested in taking the next one? And I have a feeling the answer might be yes. So let's take a look at some examples so I can illustrate and tie all this together, Tom. All right, so here's an example of a trade on Adobe. Now this might upset a few of you. This is different. This is like traders gone wild. What we're doing here is we're buying a straddle on Adobe. We're buying a 6750 straddle. All right, the earnings, follow my pointer down here on the chart, the earnings is 8 days away, and yes, we are buying 11-day options. Why? Why am I buying 11-day options? And why am I getting in 8 days before? Why would I do that? Look at my theta over here. That measures how much time, how much value we lose each day. Why would I ever do that? Well, the reason I would do that is because what happens in the earnings is that IV rushes up. It's already started. Options are already expensive. The concert starts in 8 days. I'm buying these expensive tickets and I'm going to sell them the moment before the concert starts. That's what this strategy is all about. So I want you to keep an eye on this risk graph. What I'm going to do is illustrate something really beautiful. I want you to keep an eye on, see where the red line is here. This is the risk graph on today. Now, notice that if I wait to expiration based on time decay, look up here, the green line, if I wait 7 days, which is about what we're going to wait, I should expect to lose $697 on this straddle. So something has to happen to offset that. And what I'm counting on offsetting that is IV rush. IV rush will push against these lines as they decay, as they move into loss, and push them this way, push them even into profit. So let me show you what the risk graph looked like on 6/17. That's the earnings date. That's 8 days from now. So let's go to, I already forgot the date, 6/17, and let's see what happened with this particular straddle. In this particular case, we have in 8 days a pretty low-end return on investment of 12%. I got to say though, 12% in 8 days is pretty awesome, particularly if you see what happens here in the risk graph. The IV rushed up so much that there is absolutely no risk in the trade. In fact, the stock did nothing for 8 days, stayed exactly where it started. 8 days later, we made money because IV rushed sufficiently to jack these colored lines into profit. Now, imagine if the stock had moved to 70, which it very well could have done. We would have made $566. If it dropped down to 65, we would have made $414 on this $2,000 trade. This is beautiful. Now, this is small. This is not, you'll see some examples that I'll show you here in a few minutes where this is actually more extreme. But imagine being able to generate 12% virtually risk-free. And that's what's available here to you. My favorite, now, I told you when I started, my goal with this particular strategy was to find something that was easy, that even the novice of trader could master. And in the event that you're wrong, and this system is not 100%, there aren't any that are, but in the event that you're wrong, you only lose a little bit. That's the number one benefit in my mind. So imagine being able to place trades where you're really not risking that much, and while you're waiting for IV to rush, the stock moves into earnings, you make money, and that's really the benefit of it. So I teach a class. I taught a class last fall, and one of the students, I want to show you some of the trades our students did in class, and this is one that a student built on UPS, United Parcel Service. And this was a 13-day straddle. Why 13 days? Well, the software told us that was the optimal time. It went back and back tested 20 days per earnings period over the last 4 earnings periods, and deduced and calculated that 13 days was the optimal entry point for this particular stock. So it's different on a stock-by-stock basis. So the earnings in this case was on 10/27 before the market opened. So the rules would say get out on the 26th, the night before. That would be the last trading day. So let's see how this one actually did. So we're going to go to 10/26, and let's see what happened. Now we have our IV chart down here. IV is already elevated. That's on the way up, looks like. And this trade, this is a student trade now. This student made 30% in 13 days on this trade. And again, look at this beautiful IV rush effect. There is no risk in this trade, ladies and gentlemen. I can't say enough about how beautiful this is. The stock happened to move as well. So the stock moved up, but nowhere, if I follow this, my pointer on the line, nowhere do you see there to be risk today in this trade. So that's the game we're playing. That's the game we're playing. Also in class, one of the things I love about these classes that we teach, all of Tom's classes and all of my classes I've always taught, is really we teach people how to fish and use the tools and trade successfully. But what we also do is sort of teach you to fish for yourself. So this same student found out, did some analysis, and you'll learn how to do this in class. We have a ranker that's called the earnings effects ranker that will go out and find earnings effects, like does a stock move up or into earnings, does it gap at earnings, does it drop after earnings, things of that nature. And what she discovered was that American Airlines went up into earnings the last 4 times. So it had a directional bias. So she got really crazy and bought calls. She bought a straddle but held the put, didn't buy the puts. So she bought a call option, 10 of them in this case. And you can see the IV effect here as well. So she was counting on the stock rising into earnings, which it had tendency to do, and she was counting on IV rush. So
hey, Mike,
based on, yes.
We just had that same thing. Everybody that's on this broadcast tonight got an email from me. Was a week ago, and I was talking about United Healthcare and the fact that United Healthcare had a rush into to the upside, price and volatility, and that's exactly what ended up happening. I actually sent a follow up email out just a couple of days ago, attesting to the fact that the options on United Healthcare had gone up. I believe it was like 40%. Just the call options within a couple of days, and it was it was a 100%, 100 over 100 in terms of price going up and volatility going up over the last 4 quarters. And this was stuff we just found right off the tools. But I see what you're showing is something completely different. It's something that's very unique and actually had to have some special stuff built, and a lot of manpower and a lot of dollars were put into that.
Absolutely.
Hey,
Absolutely.
you got some trades you want to show these guys that we're looking at into February here too, don't you?
I do, but I want to show how. Yes, I will. Next, I'll do that. But I want to show you how this trade ended up. So I get so delighted when students hit a home run, and here's a home run that this person hit. She followed the rules, and the rules would have her get out at the day before earnings, and this particular trade would have made 628%. She actually got out at around 200% profit. We actually delta neutralized, and she made some good money. But just the power of tools, Tom. And you can see here, you get you get some knowledge. You have a tool that goes out and does the work for you, identifies these patterns, historically backtest them, and it's a beautiful thing. All right, I think you can tell I love what I'm doing here. I love this stuff. This is a strategy that's a life-changing strategy in my book.
By the way, Pat is telling us that UPS is doing quite well on this once again this earnings cycle, and for those of you that are in our forums, that use our tools and in our forums. She's in there quite a bit. She's very vocal, and you can learn. You could, those of you that are out there, you can learn a lot from her because she is one of our partners who've been with us since the beginning, and has just really jumped on and has become kind of almost like a student coach out there.
Yeah, I'm going to have Pat teach one of my classes coming up. Get ready, Pat. And you mentioned the discussion boards, Tom. So just quickly, here's a discussion board from this group, and there is gold in these posts. You can see it's a very active class, and I don't know how many total posts there are, but there's a plethora of information. And these discussion boards are all about me providing you information, but you interacting with me, interacting with each other. There's a lot of case studies on here, people trading, exchanging trades and ideas. It's just really a rich community that's all built around this particular strategy, and the forums are all around that. So all the different classes we teach have these. So and Pat's all over the board here. That's one of you can see here. Bye Pat. Bye Pat. Bye Pat. Awesome, Pat. I really appreciate you, and I loved your contribution to our class. I got a present for you though. Here's one, and I did some scans. Now, by the way, a scan for me is click a button, and I look at the results. So here's one of the trades we're going to talk about in February. Now remember, that February is the tail end of Q1 or end of year earnings season. So there's less in February than there were in January, but there's still a lot. So I pressed a button, and this one came up. This one is SCANA. SCG is the symbol. And check this out. Over the last 10 earnings periods, this particular stock made money 100% of the time, 10 of 10, and the average return on investment was 32.67%. So what do you think the probabilities are that the next earnings period we'll get something like the same? Well, I'd say they're pretty high. So here's the trade, and all the details are here. In class, we'll talk about all these parameters here. But here's the risk graph of the trade. But I want to give you the entry and exit dates. So again, this thing has worked the last 10 earnings periods. That's over 2 years. That's 2.5 years of earnings. This thing averages 36%. This is a ride the red wave straddle. We're buying short-term options. So the entry date, and you want to write this down or just review the recording, probably better to write it down. On February the 8th, you want to buy to open a SCANA February 19 to 16. That's February. This is a weekly option now. On the 8th, this thing will have only 11 days of time left in it. So you want to buy a straddle at the current strike price. At the money means the current strike price. So if SCANA happens to be trading at 60, you buy a 60 call and a 60 put. February 60 call, 60 put. If it's trading at 55, you buy the 55 call and put. And do that, this is really important, in the last hour of the trading day. So between 3 p.m. Eastern and 4 p.m. Eastern, you enter the trade. You buy your straddle. And then you exit the trade, on February the 17th. That's the earnings date. And by the way, this information is right out of the scan. What I want you to do on the exit date is February 17th is just sell your straddle, whatever strikes you have, and do that during the last hour of the trading day. And by doing that, you'll have sold your straddle before the earnings announcement. And the last thing I'll say before I go any further is that this is not an advice or a recommendation. I'd like you to paper trade this and know that historical behavior is no guarantee of future success. However, it's a good indicator. So there you go. That's one trade I'd like to just have you have a play with and check it out. And if you want to place the order in Options Express, this is how you do it. SCG February, assuming the stock price is at 60, buy the 60 call, buy the 60 put, you buy to open, do one, and then do a limit of debit of whatever the close to the natural price is on the day. So that price will be different, and the strike prices might very well be different as well. And do that good till cancel. All right, so do that during the last hour of the trading day. All right, now there's many more opportunities. This class is all about case studies. I wanted to show you 3 that are on the radar screen. There's others besides these, but this is TJX Companies, the first one. Over the last 7 earnings periods, this thing has been a 100% winner. So over the last 7 earnings period, each one of those trades made money to the tune of an average of 35.86%. So we'll be talking about that one. Kraft Heinz, it's a new listing, 23% over the last 2 earnings. That's all the earnings. And then Waste Management, over the last 6 earnings periods, it's worked 100% of the time, and an average of 21.23%. So these are just 3 examples of the trades that we'll be analyzing in class, and there's more than these, of course. So just to give you a taste of what you can expect going forward over the next 5 weeks. All right, so I'm going to open it. I could talk all night, Tom, but I'm not. Questions and answers. Any questions that you might have about anything I've just covered? Anything at all?
I'm looking here. First of all, let me just mention this to everyone. I'm seeing every once in a while, sound might be going in and out, and keep in mind that we do have a recording of this, and that the sound's coming through for the most part clear through our end on the server side. So if you lose it here and there, it more than likely may be something between you and I, but we're getting it, and you'll get a clean recording, that's for sure, for those of you that want to listen to this broadcast again. There's a good bit of questions here, and I'll take a couple of them here, and then Jay, if you see anything else that pops up, let me know. But one of them that is when you enter and exit these, do you do them as market orders? Do you do them as limit orders? What's your suggestion there?
That is a really, really good question. Now, ideally, with this strategy, here's what I do. I like to be there on the entry and the exit, and I work the bid-ask spread, because one of the things you want to, and we'll teach you how to do this in class. One of the things that you need to deal with is, because there's, particularly on the exit, but it's the same on the entry, but not quite so severe. The bid-ask spread might widen a bit. So what I do is, maybe starting at 3 o'clock, I'll place an order with a limit and be aggressive with my price. Maybe I'll do it halfway between the bid and ask. So I'll start with a limit order, and then I'll relax it as I approach the 4 o'clock time frame. So I work the spread basically. If you're not able to do that, then what you need to do is a market order. So ideally, and now remember, this strategy works so well that it would behoove you to be there for an hour on the day of entry and exit and work the spread. And again, I'll teach you how to do that. But if you're not able to, then a market order is really your only choice.
And the other one too is that one of the folks is saying that the trade entry said February 8th, but then saw it's February 19th. The trade entry is on February 8th, but it's for the options that expire on February 19th. So don't get that confused. All right.
Right.
You know, what we do is we strategically enter and exit these trades on certain dates. All right. And you know,